if you're a veteran or active duty, or maybe a realtor or a spouse of somebody who is one of those things, or you're thinking of joining the military and you've heard about a VA home loan and you just want more education, that's what this video is for. This is the 2026 guide. Everything you need to know will be in this video. I'm covering everything from how to know if you're eligible to your closing costs to VA disability, pretty much all of it. Not pretty much, just all of it. And it is a long video, so kick your feet up, get you a coffee, get you a notepad, and we're going to get into it. With that being said, I am Mortgage Murph. Thank you for visiting my channel. I am a veteran turned loan officer. I was stationed over at Fort Campbell. I was an 11 Bravo. I know you're going to hear that and be like, oh, he's 11 Bravo. He's stupid. Okay, yes, but no at the same time, right? I'm trying to bring the energy to make this a fun and educational video. There's no sales pitch. There's no hype. There's no lies. This is just information that I am giving to you as my fellow veteran or veteran-S, whatever it is. But with that being said, we're just going to hop right into it. So what is a VA loan? A VA loan, right, is a mortgage that is backed by the Department of Veterans Affairs. The VA is not the one that is giving you money. People, if you stop this video right now, you already know more than most people when it comes to VA loans. Everybody thinks that a VA loan, the money comes from the VA. Your lender is the VA. That's not true at all. All the VA is doing is guaranteeing part of the loan, right? The loan comes from private lenders, be it banks, financial institutions, investors, things of that nature, right? So what the VA actually does, the VA guarantees 25% of the loan, right? That's it. That's basically all the VA is doing. So if a borrower defaults, the VA is responsible for 25% of the lender's loss, which is basically the down payment, right? You don't have to make a down payment using this loan as a veteran, which is one of the biggest barriers to entry. So the way you have it is the VA is saying, hey, you know, I'm going to give you 25% of this loan, just done, opposed to the lender getting, you know, oh, I only want to do a minimum down payment of 3.5% or 5% or whatever it is, right? I use this example all the time of, imagine you have two friends who ask you for money. Friend number one says, hey man, I need $1,000. I don't have anything I can give you. Can you just give me the 1,000 and I'll pay you every month? All right. Friend number two says, hey man, same thing. I need $1,000, but I want to give you my Xbox as collateral, so that if something happens to me, at least you have my Xbox. Friend two, you're going with friend two every single time, right? And that's basically the same way that the lenders see it, is the VA is saying, here's an Xbox, hold on to it, right? Not literally, but why this matters for veterans is this is what allows the zero down payment, no monthly mortgage insurance. With a FHA and conventional loan, if you do not put 20% of a down payment, you have to pay monthly mortgage insurance until you get up to that percentage, right? FHA, it goes on forever. In most cases. So that in itself is a very powerful thing, right? More flexible approval compared to conventional loans and FHA loans. It's overall, it's great for veterans. I don't see why people don't use this if you have it. Why lenders love this? Because one, it's government-backed risk protection. They don't have to worry about that 25% because it's already done. It's taken care of. Historically, VA loans are on par, if not better, than your normal loans, your FHA and your conventional loans. It just depends veteran to veteran, you know, your credit and things like that, right? Why this benefit exists: to encourage post-service stability. I am very honest and open about this. I don't care if you are private or a general. I don't care if you are a cook or you are Delta Force, Ranger, Special Forces, right? You, in some capacity, served our country, and this is your benefit that you get for doing so. Basically, yeah, encourages post-service stability, supports long-term home ownership, and reduces foreclosure risks on the veteran. You're not going to have to put that 25% down up front or anything like that. So you're not having to spend your life savings on this. So it's less risk on you and more risk on the VA, right? It's not free money. It's not a charity. It's a risk sharing agreement between the VA and a lender and yourself. That's basically all it comes down to. So key points of this is the VA guarantees 25% of the loan. That's why it's a zero down payment for you, and that's not a charity, right? I'm going to use this very quick example, right? If you are buying a $400,000 home, the VA covers 25% of that, which is $100,000. So looking at that, you didn't put anything down, and the VA basically told the lender, here's $100,000, it's covered, we're good to go. So the lender is protected, similar to somebody putting down $80,000, $100 on like a conventional loan, and you don't have to pay any PMI, right? Eligibility, right, is one of those things that a lot of people get confused about because there's a lot of this and that on the internet, right? So VA loans are eligible for veterans, active duty, service members, and certain surviving spouses. Eligibility is based on time in service, not credit or income. Eligibility is from your approval letter, certificate of eligibility. You don't got that, you're not approved. You need that. It's as simple as that. So let's get into it. Active duty service members eligible after 90 consecutive days of active service during wartime. Eligible after 181 days of active service during peacetime. That's all of you. Basically, if you joined the military and you went active duty and you did your, I don't know what the minimum contract is now, 3-4 years, and got out, as long as you were honorably discharged, you got it and you're good to go, right? You can use the loan while you're active. A lot of people don't know that part. You don't have to be out of the military to use it. If you're active, you can buy a house every time you PCS, right? Veterans, this is people who are separated from service. So immediately, active duty people, you're classified as a veteran, because the time in service and everything is the same thing. So it's technically the same thing, a little different. Veterans, right? 90 days active duty during wartime, or 181 days of active duty during peacetime, or 24 months of continuous service if you enlisted after 1980, or officer after 1981. A lot of people get confused on this, and basically the only thing that matters is you were active duty, you got out, you're a veteran, done, classified, easy peasy. National Guard and Reserve members, you guys are kind of the bane of my existence, right? A lot of it's not a tricky situation, but the paperwork's usually a little bit more messy. And I want to say this immediately right now. If you were active duty or a veteran, and then you decided to go to the reserves or the National Guard, none of what I'm about to say matters. You were active duty or a veteran, you're done, classified, boom, check that box, you're good to go. National Guard and Reserve members. Eligibility after 6 years of service in selected Reserve or National Guard, or you're eligible 90 days of active duty service under Title 10 orders, deployments, things like that, typically is what that means, or eligible if discharged due to a service-connected disability. You cannot get a service-connected disability in the National Guard or the Reserves unless you are activated. If you are activated, it automatically turns you into active duty, which turns you into a veteran. You see how the circles, everything goes together here, right? A lot of people just assume they don't qualify, and they just talk to me, talk to somebody before, and we can get you squared away nice and easy. Next is the surviving spouses. It is brief but important here, right? Listen, if you are a surviving spouse, immediately, I am sorry for your loss. Thank your spouse for their service. It's always a sad thing to have to talk about and discuss, and it is my least favorite phone call, but it is also my favorite phone call because your spouse served, and that benefit still belongs in the family, and I would love to help you with that. So, unremarried surviving spouses of a service member who died in the line of duty or a veteran who died from a service-connected disability. An example of this is you were in the military, you did not have cancer, you got out, you got cancer, and it is connected to your time in the service, and then you succumb to that cancer and you pass away. Your spouse can use your benefit, right? Some remarried spouses may still qualify, but it depends on age and timing. It requires a lot more paperwork to get it done. Certificate of eligibility is proof of a VA loan eligibility. Well, it's technically proof of your service and that you have access to these benefits, but in this instance, that's what I'm going to say. It is issued by the VA, right? It confirms your eligibility status. It's not a loan approval. It's just saying, yeah, he did his time and he can use this, right? Ways to obtain it: online through the va.gov portal, through VA approved lenders like me. If you are doing your loan with me, I don't make you get your certificate of eligibility. I just grab it for you because it's easy, right? By mail, slowest. Don't get it by mail. Please do not get it by mail. What eligibility does not mean: does not guarantee that you are approved for a loan, does not bypass the credit or income rules and reviews, and it does not remove the occupancy rules. It just means you have access to this benefit, right? So the big things with closing this one out is that if you are unsure, links are down below. Get in contact with me and we can figure it out and get you where you need to go. We're going to get into the real benefits. I covered some of these, but I'm going in depth with all of them now, right? So the number one thing is the zero down payment. You heard me say that the VA guarantees that 25% of the loan. You can still add money for a down payment if you so choose, right? But it is giving the option that you don't have to if you don't want. Instead, you can do something called a rate buy down. Fake numbers here. If you got approved for a 6% interest rate, instead of putting any money for the down payment, because the VA already did that, you can put money into buying your interest rate lower. So instead of a 6, you can go to a 5.55, 5.4, 5 even. It depends. It does cost money and it depends on other things, credit, debt to income, and things like that. But your down payment is optional. It's not mandatory, right? Zero down doesn't mean zero cost. Closing costs still exist. You still have to pay them, right? Down payments can be used strategically. I'm having a stroke, right? There's a lot more that you can do with them. But it's very powerful because, one, it keeps cash in your savings. You're not having to throw that $80,000, $100,000 up on the front end. You keep it, right? Allows earlier home ownership because you're not saving for that down payment. You don't need it, right? Reduces delay in savings, right? Because you're not paying the private mortgage insurance. And we're going to immediately move into that, the private mortgage insurance, or PMI. You don't have to have it, again, because the VA put the money down. So the way this works for comparison, right? Here's our chart. FHA is you have to put a upfront mortgage insurance as well as pay monthly. Conventional, right? It's required if you're not putting that 20% down. FHA, that mortgage insurance stays on the loan the entire time. It doesn't go away. Conventional, on the other hand, automatically goes away at 22%. You can call them and get it removed at 20%, but if you don't do that, 22% is when it is going to be removed. And VA, obviously, 0. And this is directly, tied to the long-term cost of the loans and your monthly payments, right? Competitive interest rates. So the VA often has lower rates, as I said, or at least on par rates with conventional and things like that. This is due to that 25% coverage from the VA. Rates advantage vary by credit profile, market conditions, lending prices, and things like that. Lower rate almost always means the best loan with a VA loan, not with conventional or FHA. But there's a lot of strategic things that can go into it. So if you tie all these things together, zero down and no PMI equals a lower monthly thing. You have savings, right? You didn't need to save money. So all that money you have saved is yours. Do with what you want as you please, right? It's flexible. It helps veterans. It helps everybody. It's just so much better. No PMI, you keep your savings, zero down. It's kind of a hard thing to beat, right? I mean, to me, it's almost the perfect thing. Now, with all those great benefits, unfortunately, the other shoe has to drop sometime, right? This is the VA funding fee. This is one of those things that everybody gets this is the most confused topic, so please pay attention to this one, right? The VA funding fee is a one-time fee, not a monthly charge. You can roll it into your loan and make it a monthly thing, but we'll get that later. It helps fund the VA loan program so it can continue long-term. This is basically what replaces your monthly mortgage insurance on the VA side to a degree, right? It is paid one time, either at closing or rolled into the loan. It's not paid every month. So the way this works is basically veterans have to keep the program funded, right? Because if everybody got zero down, that money's going to dry up really, really fast. So the way the VA does this is you have to give them something. It is so much less than private mortgage insurance and a down payment and things like that, but it is just enough to help with the loan for all the other veterans and things like that, right? So I'm putting the numbers on the screen. This is how the VA funding fee works. You can see over here, there's a difference between the first time you use it and every subsequent use. I say that because you can have more than one VA loan and more than one VA property, right? This is the proof right here is the funding fee shows you this, right? So as you can see here, putting 5% or more down drastically reduces the number on the funding fee. The biggest jump is between the first use versus the versus the second time you use it at zero down, right? So a VA streamline refinance, an IRRRL, right? Most people don't do this and don't know about it. The funding fee is 0.50%, right? That's just throwing it in there just to cover your butt with everything. But that's a totally different topic. With that, that is a refinance, right? So you get your VA home loan, you live in it for some time, some rates drop, you want to do a refinance. The VA has their own veterans refinance thing, right? So how the funding fee is paid, like I said, it can either be paid out of pocket. You can just say, take it, I got the money. Or you can roll it into your loan amount and just pay it on the back end. Example, if your funding fee is $6,000 and your loan amount is for $400,000, you would just get a new loan amount of $6,000. Done. I don't know why I said that number so weird. Sorry. Long day, right? Also, with a VA home loan, you can have the sellers cover it. They can totally cover this fee for you if they so choose. It's another negotiating tactic that makes the VA home loans just as strong as it is, right? And again, you have to pay this in order to avoid the zero down in the monthly payments. It protects future veterans is basically what it is. So funding fee exemptions, this is bread and butter, right? Most of you VA veterans, most of my veterans out here I deal with take VA disability, right? Again, whether it's 10% or 100%. So you are exempt if you receive 10% or more VA disability compensation. You are entitled to VA disability compensation even if it's not paid yet, or you are an active duty Purple Heart recipient. As well as a surviving spouse receiving the DIC benefits, different thing, more paperwork and whatnot. And exempt, I mean $0. Doesn't cost anything. You never have to pay it. And if you are a veteran, chances are you should be getting VA disability. And if you're not, work with somebody to get the VA disability, right? So here's the example I'm going to throw up on my face here, right? Is your purchase price is $300,000. It is your first time VA use. You put zero down payment. The funding fee is going to be 2.15%, which equals $6,450. If you roll it into the loan, your new loan amount just goes up by that $6,450, right? Again, it's not as bad as people make it seem. comparatively, imagine if you had to put a down payment yourself and you didn't have enough and you had to do the private mortgage insurance and then you had to cover all your closing costs by yourself because it's not a VA loan and the seller didn't want to cover the extra percentages. I'm just saying, it's a powerful thing. Credit and income. So it's a little different on a VA loan than it is to FHA and conventional because there's just extra things that can be done. Right? The numbers and everything are different than if you were the same exact person with the same credit getting a conventional loan versus FHA versus, a VA. So the VA does not set a minimum credit score. The VA doesn't care. There is nowhere in the guidebook that says you must have a credit score of at least blank to use this benefit. Does not exist. Credit requirements come from the lender, not the VA. Most lenders look for 580 to 620. It varies. Some of them, can go less and some of them can go more. It's each bank, each institution, everything has their own rules of what they want. It's called a lender overlay. Let's say that the minimum credit to get whatever loan is 500 legally, right? The lender can say, I don't do that. The minimum that I'm going to work with is going to be a 580. I only want 580 and above. Is it fair? Sometimes yes, sometimes no, but just find a different lender, right? So underwriting looks at your entire profile, right? It's not just your credit score or things like that. They look at every single aspect of your life when it comes to money that comes in and money that goes out. Right? What matters more than credit? Payment history, right? Have you been at your job for a long time, for 2 years? Or did you just start a new job? One of these shows stable and, stable income. The other one is, I don't know, he just got it. You could be there for 20 years, but we don't know, right? Recent late payments as of 12 months is what matters the most. Is they look at the last year for stability and they say, okay, well, everything's paid up, everything's good, no late payments, you're good to go. Collections and charge off, that's a case-by-case thing, right? Some lenders have their own way of dealing with it. Others don't care. It really just depends on you and your specific lender, right? Income basics for VA loans. Income must be stable, likely to continue, and documented. Basically a 9-to-5 job, or if you own your business and you can show, hey, I'm making this much money. I've made this much money for the past 2 years, right? Common acceptable things is a W-2, hourly or hourly income, military base pay, allowances like BAH or BAS, and VA disability income. And VA disability income is a golden ticket, right? VA disability income rules. VA disability income counts as qualifying income. 1, it's from the government. 2, it's tax-free. 3, it is stable, right? Lenders can gross it up, which is crazy because you can't do that with other things. This is the only one that you can do, right? Well, there might be some others, but for the sake of this video, so example of you get VA disability, you get $3,000 a month. A lender can add 25%. So now you make $3,750 a month. That's crazy powerful, right? Debt to income ratio. VA loans do not have a hard DTI cap, right? 41% is a common benchmark. It's not a hard limit. VA loans allow you to go much higher debt to income than if you were doing a conventional or an FHA loan. Another reason that it's, again, I keep saying powerful, but I don't know what else to say, right? Higher DTIs can be approved if your residual income is strong and your credit profile is solid. What is residual income? Here you go. Residual income is basically the money that you have left over from paying your debts and housing and things like that. So it's the money left over after everything's paid for, right? VA sets minimum residual income amounts based on family size and region of county. An example is a family of 4. It could be $1,000 a month if they're living in the Midwest, opposed to somebody who's living in the north or south or whatever. It could be 2,000 with a family of four. It depends. Typically, if you live in a more expensive area, the numbers change, right? What usually causes credit/income issues? Number one thing is recent job changes. Like I said in the beginning, we don't want you got a brand new job. I don't care if your brand new job pays you $1 million. That could go away like that. We need to see you've had a job. It's a stable job. You've been getting money. You can have 2 jobs. That's totally fine as long as you keep the one that has all the important information on it, right? Commission or self-employed income without a 2-year history. If you get commissions or you are self-employed, 2 years. Baseline for everything is 2 years. 2 years of income is what we need regardless of what it is. I'm just going to say that out loud, whether it's that is how I personally do it, right? Large unexplained bank deposits. The VA is the government. The government doesn't want you laundering drugs or things like that. Come on now. You can't just have $80,000 pop in your bank account and not say why and try to use that money. They need to know why. Is it a gift? Is it an inheritance? What is this money? Where did it come from? Right? So the example in this one is the veteran gets $5,500 per month. The VA disability is $2,000 per month. Right? So we're going to gross that disability up and it's going to be $2,500, leaving the total qualifying income of $8,000 per month. DTI slightly over 41%, but strong residual income, right? The formulas are so different and are case by case and depend. There is a guideline of rules, soft rules that need to be applied for it, but you are an individual person with an individual social security number, with individual credit, debts, and income. That's why you need to talk to somebody who's going to go to bat for you. VA occupancy rules. This is kind of a weird one, and a lot of people, again, don't understand it because there's a lot of misinformation. I was going to say communication. I guess that's standard. So core occupancy rules. The VA wants your loan to be for your primary residence, right? The borrower must intend to live on the property, and it is not designed for an investment-only purchase, right? Intend to occupy, not a forever home. That is the difference. That is where a lot of people don't understand because somebody says, oh, I bought a VA, I used my VA home loan, I got a house, and now I just bought another one. Well, how? If you have to live, you don't have to. You intend to live into the house. You intend to occupy it, not forever. All right. So what does that look like? The move-in timeline. Generally speaking, you have 60 days from the close of the loan to move and live into the home. Now, there are stipulations and extensions and things like that for things like, well, you got PCS orders if you're on active duty, or it's a construction loan, right? Or there's repairs that need to be done, or other documented circumstances. It's not automatic that you get this, and it has to be a justified reason, right? You can't just, I just didn't feel like it, right? Generally speaking, 60 days, get your butt in that house, start the counter, right? So what counts as a primary residence? A single family home, right? Obviously, just your normal home, right? Condos are a little different. They have to be approved by the VA. Multi-unit properties, up to 4 units if you live in a unit. You could buy a duplex. You could buy a quadplex, right? Living in one unit satisfies that requirement. You can immediately rent out the other units. PCS and military moves. This is very important. PCS orders does not kill a loan, right? You can be active duty and buy a house, and then you came on orders and you're immediately like, I'm going from Fort Campbell to Dallas, Texas, right? But I just bought my house. That's fine. You can immediately start renting that home out. PCS orders trump everything else. Renting the home later is generally acceptable once you've met the typical occupancy time. But for PCS, you're good to go, right? Renting out the property later, the VA allows renting after you've met the occupancy intent. Timing matters here, right? So if you buy the home and immediately rent it, that's a problem. That is fraud. You lied, right? Rental after a legitimate occupancy is, for the most part, typically okay. The way that works, though, is the VA does not set the rules. The VA doesn't say you must live in it for X amount of days or X amount of years or weeks or months or whatever. The lender is the one who does this. And for most of the time, they're very hush-hush about it. So for it to be your primary residence, technically, you can live in it for 6 months and 1 day. Because out of the year, that was your primary residence. Most people play it extremely safe and they just stay in that place for 1 year, right? Because it helps nullify any of the questions or anything else that can pop up, right? So in the example that I'm going to use, right, veteran, you buy a home, you move in it within 30 days, you live in it for 12 months, you get PCS orders, you rent it out and go get another house. Or you're a veteran and you bought this house, you lived in it for a year and you decide that you want to move and buy another house. You can sell the original house or you can rent out the original house. It really doesn't matter. The key things is that you must intend for it to be your primary residence, which doesn't mean your forever home. And don't try to buy a home and immediately rent it out. I'm telling you, the VA and the lender is going to find out and they're going to get you. The VA appraisal and property requirements are a very messy thing, and a lot of people only understand a lot of myths and negativity about them. Let me explain why it's not. It's such a good thing, right? And why you need it. So what a VA appraisal actually is. The VA appraisal serves two purposes. Number one is it confirms the value of the property, just like any other appraisal. Number two, it confirms that the conditions meet the VA standards. So if the house is worth what it is, that's totally fine. That's cool. The VA wants to make sure this is a good investment. They want to make sure that you're going to last in this home forever, right? Then they're not going to do that if the house is just falling apart. So the VA appraisals are not stricter. They're protective. That's it. That is the only difference. And honestly, I've never met a veteran who's had a problem with this, because if you're buying a home, you want to make sure that it meets all the requirements and that you're going to be safe. So the minimum property requirements. VA requires a home to be safe, structurally sound, sanitary, and livable. Those are the four most important things. It's not about cosmetics, right? They don't care. They just want to make sure that the home is safe. So common VA appraisal issues, things that might get flagged: peeling or chipping paint, especially in pre-1978 homes. Why is there chipping paint? What's the actual problem behind this? Roof issues, if the roof is at its end of life or if it's leaking, exposed wiring, that's going to cause electrical fires, broken windows, that's not safe, that's not secure. No heat source and no water. Those are what you need to have a house. That's literally what a house is, right? Things that don't matter is old kitchens, ugly carpet, ugly paint inside the home, dated bathrooms, and cosmetic wear and tear. They don't care about those things. They just care about the structurally important things. If it's a very harsh winter storm, you got to have heat. Simple, right? VA appraisal versus VA home inspection, versus a home inspection, not a VA home inspection. That doesn't exist, right? So an appraisal and an inspection are different. The appraisal protects the lender. The appraiser comes and says, look, it met all of your requirements. You are good to go. The home inspection protects you, the buyer. And they're both just very important things. The lender wants protection and you also want protection. You don't want to buy a home to find out that all of the electrical inside is jacked up and it's going through the plumbing inside and it's water. Like, you don't want that. You want your house to work. So home inspections are very, 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 very important, right? Why VA appraisals get a bad reputation? Sellers are the only people that do this. Sellers confuse conditional standards with being strict. The standards are not any different to a degree. They are slightly different, but the time it takes, minimal. It doesn't matter. People do this all the time. Well, oh, you don't have enough time to do an FHA home loan because the inspection. No, shut up. You're wrong. You're wrong. And if you're just, conditional standards are around the board. If you go get a conventional loan, they're going to look at similar to the same things. Well, what's the electrical panel look like? What's the heater look like? Things like that, The only difference is that, the ruling on what's acceptable and what's not. People give it such a bad rep, and at the end of the day, it's there to protect you. It's there to protect the lender, your family, anybody who comes in the home, and then even to a degree the seller. Because if you buy a home and then later you discover they hid a bunch of stuff, like, that's not good for anybody. So what do you do next as the veteran now that you have this education and I've told you almost everything you need to know? Well, get more education. Right? Don't rely on social media comments. Don't rely on your friends. Don't rely on outdated experience. Talk to somebody who knows what they're doing. I don't give tax advice because I don't know anything about taxes. I wouldn't go on the internet and talk about taxes. I wouldn't lie to anybody about taxes. I go to a tax person. I don't ask my friends. I might ask their opinions, but at the end of the day, I'm talking to the tax guy and they're doing my taxes for me. There's just so many misunderstandings that can create big problems later. My advice is that you talk to a lender. I'm a lender. If you want to talk to me, all links are below. So do it before you go house shopping. Do it before you make an offer and before you're just trying to run numbers in your head and figure stuff out. The earlier you can get the picture painted for you and understand, okay, well, I have this much income, but I have this much debt, and Murph said I need to fix my debt. Well, I told you now, right now. So you have the time to fix it before you want to buy a house. I deal with people who I give them a plan for a year out. I say, I'll call you next year and you follow this plan. We'll figure it out together, right? It clarifies your buying power. It identifies the issues and prevents all the deal breakers and killers and things that are out there. And all any lender asks is that you be honest, right? Income changes. What's your timeline looking like? What's your credit concerns, your long-term plans? Are you going to live in this house forever? Or do you want to buy it and live in it for a bit and then go and do, rent it out and buy another one? Or is your plan to refinance? So you don't care what your interest rate is and you're looking to get money up front. There's so many things to do it, but I'm just telling you, please ignore all the noise that's out there, right? Headlines are designed for clicks. Rates, prices, and rules are always changing. There's nuances. There's some things are this, some things are that. Most of the time is you have a general guideline that you can follow. But if something changes, I am made aware of it and I have that education and I can help you out, right? Your personal situation matters more than what the market is. I have videos on here about, waiting for the perfect time to buy and why it never happens. Think long-term, not just today, right? Your first home doesn't have to be forever. You can have more than one VA home loan. Strategy matters. I'm not good at chess, but I am very good at strategically helping people with home loans and their future, right? That is all I have. Like I said, I am Mortgage Murph. Thank you for staying through this entire video with me. I truly appreciate it, even if you skipped around. I hope you learned something, and if so, comment, subscribe, I don't know, do something. Let me know. I'm going to hit you with my cheesy salute since this video is marketed towards the military. Thank you, sir or ma'am or private or whoever or whatever you are for your service. See ya.